This is a review of problem 15-10A Part 1 in your assignments. In the problem, we're given a trial balance and we're going to enter the adjustments for a merchandising company. In A and B, the merchandise inventory is $31,600 as of December 31st. So someone has gone in and counted the physical inventory, and the actual number is 31,600. However, if we go down to our worksheet, we see in the trial balance we are reporting 30,000. So to adjust inventory, the first thing we do is remove the old inventory figure and then put in the new figure. Our old figure is 30,000 as a debit. To remove it, we're going to credit it for 30,000. And then the offsetting debit will be in the income summary account. The next step in adjusting this inventory is to enter the current figure. So our new inventory figure is 31,600. So we'll come down to merchandise inventory and debit it for 31,600 and then credit income summary for 31,600. Now when we move the merchandise inventory figure over, we have a 30,000 debit and a 30,000 credit, which gives us 0. The only thing that's left is the 31,600 debit. Now, using the same process, we are going to adjust the estimated returns inventory figure. For C, D, and E, Vicki estimates that customers will be granted $2,500 in refunds of this year's sales tax next year, and the merchandise expected to be returned will have a cost of $1,800. Now, the refunds are the retail amount that we are going to owe our customers on returned items. The $1,800 is the amount of the cost of the inventory they're returning. So we need to now update our returns inventory to $1,800, and we're going to use the same process that we did in A and B. So our estimated returns here is showing a 3,000 debit, so we need to get rid of that old number with a credit of 3,000, and then we're going to debit income summary for 3,000. Our new number is 1,800, so we're going to debit estimated returns inventory for 1,800 and then credit income summary for 1,800. And then when we bring our balance over, it's the same as above. The 3,000 debit is offset by the 3,000 credit, so that gives us a 0. All that's left is the 1,800 debit. Now we need to adjust the amount of the refunds. The refunds are listed at $2,500, and down here they are shown as $4,200. So we need to decrease the amount of our customer refunds payable from $4,200 down to $2,500. Okay, the difference is $1,700. So customer refunds payable is a credit of $4,200. To decrease that credit, I'm going to debit it. Remember, all credits are, or all liabilities are increased with credits and decreased with debits. So I'm going to debit $1,700, and then I'm going to sales returns and allowances, and my credit will be for $1,700. Okay, so if customers' refunds payable has a credit of 4,200, we give it a debit of 1,700. That's going to bring our balance to a credit of 2,500, which was what we were told our actual ending balance is estimated to be. Unused supplies on hand. If they're unused, those are the supplies we still have on hand. We should be reporting them at $350. We are reporting them at $1,600. So that means that we have used up $1,250 in supplies. $1,600 we started off with, and now we have $350, and the difference is $1,250. So we need to reduce our supplies with a credit of $1,250, and that means we're going to come down here and debit supplies expense for $1,250. In the next entry, the insurance that expired is $2,400. This is telling us the amount that was used up. So all we need to do is figure out the accounts and use this figure. So since we're dealing with insurance, we are going to be entering this $2,400 in insurance expense as a debit, and then we're going to credit a prepaid insurance for $2,400. We'll get all these balanced out when we get to the end. Depreciation expense was $20,000, so that's a debit to depreciation expense. That was for the building. And then accumulated depreciation is the credit offset for the depreciation adjustment. Depreciation expense on equipment is $4,000, so same entry. We will debit depreciation expense equipment for $4,000 and credit accumulated depreciation equipment for $4,000. Then wages earned but not paid. That will be a debit to wages expense for $520. The expenses were incurred in this period. They'll be paid in the next, but we need to make sure the expense goes in the current year. And then wages payable will be the offset. It's going to record our liability. And then last, unearned revenue, which is a liability, should be $1,200. Let's see what we are reporting that at. Unearned revenue here is $5,000, and it should be $1,200. So if I subtract the $5,000 and the $1,200, $3,800 is the amount of unearned revenue that we've actually earned. So we need to bring down the unearned revenue to $1,200. There we go. And we're going to do that with a debit of $3,800. And now we're going to credit the revenue account costume design revenue. Now that we have all of our adjustments in, we can come in and move our balances over. So cash did not get adjusted, nor did accounts receivable. We've already brought over our two inventory figures. Supplies is a $1,600 debit and a $1,250 credit. The difference is $350. So now we are reporting our supplies at $350, which is exactly what our inventory said it would be. Prepaid insurance was $3,600. We subtracted 2,400, that's the amount we used up. So now the balance is 1,200. We'll bring over the value of the land and the building. And the accumulated depreciation has now increased. We have a credit and a credit. Oops, and that is going to give us a credit of 80,000. The equipment is valued at 90,000. And the accumulated depreciation for the equipment increased by 4,000. A 12,000 credit and a 4,000 credit will give us 16,000 on the credit side. Accounts payable did not change. It is 11,420 still. We've already brought over our customer refunds payable balance. We had a credit of 4,200 and a debit of 1,700, which will give if we subtract the two, we get a difference of 2,500, which should stay on the credit side. Wages payable was entered, so we'll bring it over as a credit. Sales tax payable was 2,000. We made no changes to it. Unearned costume design revenue started at 5,000. We decreased it with a debit of 3,800. If we subtract those two figures, we get 1,200, and the liability will stay on the credit side. Notes payable was 80,000, and capital was 387,620. Drawing 21,610. Now for the income summary, we don't net these figures together, we bring them over exactly as they sit, because the first number in income summary tells us that that was the beginning inventory. The second number says that's the ending inventory. We're going to do the same with the returns inventory. The first number is the beginning, and then the second number is the ending. Sales comes over on the credit side at 374.5. Sales returns and allowances has a balance of 12,008. It's a debit, and we credited for 1,700. So since we have a debit and a credit, we'll subtract, and we're going to get a difference of 11,100. And since the debit is higher, it stays on the debit side. Costume design revenue, we had a credit of 1,200 and a credit of 3,800. So we'll add the two credits, and we'll end up with a credit of 5,000. Purchases stays the same. Purchase returns and allowances did not change. Purchase discounts is just brought over. Freight in is 800. Wages, we have a debit and a debit. So 65,520. Total 65,520, and they stay on the debit side. Advertising expense is 810. Supplies expense is 1250. It had no balance, then we gave it a debit of 1250. Phone expense is 1210. Utilities is 3240. Insurance was given a debit of 2,400. Depreciation expense building was 20,000, and then depreciation expense equipment was 4,000, and interest expense was 3,200. Okay, now we're going to balance out the worksheet. So first thing we're going to do is go to the adjustments column and make sure our debits equal credits. And so on the debit side, we have 100,070, and we have 100,070. Let's see, I think I have too many zeros in there. No, that's right. 100,070 on this side. Okay, so we're balanced in our adjustments column, and now we're going to add the debit side of our adjusted trial balance. So remember, debits have to equal credits because it is a trial balance. This is just our trial balance with our new figures. So if we add all those down, we'll get 996,790. And then if we add all our credits, we get 996,790. Now, the next thing we're going to do is calculate the net income, but it's a little trickier since we're given a partial worksheet. We're not given the income statement column and the balance sheet columns. Even though they're not given to us, we know the figures that go on each column. Okay, so the goal here is to calculate the net income. If I were doing that on the income statement column, I would start at income summary, because on the worksheet from income summary down, the figures go on the income statement. All figures above income summary go on the balance sheet. So if I start at 30,000 and add all the figures down to the 3,200, I'm going to get $288,030. Now if I come over starting at income summary and add the 31,600 all the way down to the 830, I'll get $415,530. If I subtract these two figures, I'm going to get a net income of $127,500. Now that the worksheet is complete, I can take all the figures in my adjustments column and enter them into the journal. And then of course later we'll post those to the general ledger and bring up to date our general ledger figures. So in A, we had the adjustment to merchandise inventory. We had first a credit of 30,000 to merchandise inventory and a debit to income summary. So we will just enter that first entry that removed the old figure of 30,000. Okay, now we will flip this entry, because that is the figure, or that's the journal entry where we entered the new inventory. So income summary had a credit of 31,600 and merchandise inventory had a debit of 31,600. So if you have your worksheet figured out and balanced, then all you have left to do is just copy your adjustments down to your journal. Adjustment C is for customer refunds payable. So if we come up to our worksheet, we'll see customer refunds payable is $1,700 debit, and we credited sales returns and allowances for $1,700. So remember, customer refunds payable is a debit, but notice when I come here to try to find customer refunds payable, it's not here. It's actually in the credit section. So that's an error here in Cengage. So I'm just going to put it backwards. It should be customer refunds payable and as the debit, and then sales returns and allowances as the credit. But they do have it listed backwards there. So I'll just go with what the book has. And then on entry D, we are going to be adjusting the estimated returns inventory. Let's see. The estimated returns inventory, we debited, or let's do the the credit first. We've credited for $3,000 and debited income summary. That was to remove the old figure. So debit income summary and credit estimated returns inventory for the $3,000. And then we had to put in the new figure. We did that by debiting estimated returns in inventory for $1,800 and crediting income summary for $1,800. In adjustment F, we adjusted supplies. So we credited supplies for $1,250 and debited supplies expense. The next entry was the the insurance adjustment. We credited prepaid insurance for $2,400 and debited insurance expense for $2,400. The next entry was for depreciation of the buildings. We debited depreciation expense for $20,000 and credited accumulated depreciation buildings for $20,000. Entry I was for the adjustment for depreciation for the equipment. Let's see. So depreciation expense equipment, we debited for $4,000, and then we credited accumulated depreciation equipment for $4,000. The next entry, J, was for unpaid wages. So we're going to debit wages expense for $520 and credit wages payable for $520. And last, we adjusted unearned costume design revenue for $3,800. Okay, we reduced the unearned revenue liability with a debit for $3,800, and then we credited the costume design revenue for $3,800.